Everybody is selling Coca-Cola stock. Insiders are selling, super investors are selling, even politicians are selling. So today we are going to go through our 7-step analysis process to find out why. Is there something fundamentally wrong with this beverage giant? Or could all this selling actually create an opportunity for contrarian investors? And to answer these questions, we will be using forecaster.biz, which is very kindly sponsoring this video. Coca-Cola needs no introduction. It's one of the most recognized brands on the planet, selling its products in over 200 countries and territories. The company owns or licenses more than 500 brands, but its flagship Coca-Cola remains the world's most popular soft drink. If you invested $1,000 in this company 10 years ago, you bought 25 shares. And today they would be worth something close to $1,721. And Coca-Cola also pays dividends, so in that time you would get $408 as dividends. So if we add together the current value of shares and the dividends, we get $2,129, and that is a gain of 112% in 10 years. That's actually not bad. You more than double your money, and Coca-Cola is about as safe and stable as investments come. But the question is, why is everyone selling right now? Individual insiders, that is an X, only 0.7% of the company is owned by individual insiders, and we would like to see this number over 2%. So the management doesn't really have its skin in the game. And are individual insiders buying? That is an X. We see a lot of sale transactions in the recent quarters. The insiders are heading for the exits. And do super investors own this company? That is a check with 6 super investors, including Warren Buffett, Christopher Blumstrand, and Thomas Russo. And are they buying right now? That is also an X. Last quarter, super investors did not buy a single share of Coca-Cola and sold 51,000 shares. And thanks to forecaster.biz, we can also see what US politicians are doing. It's worth noting that they are surprisingly great investors. It's as if they have some knowledge that we don't. But of course, that couldn't be the case, because that would mean that they are breaking the law and behaving unethically. And as we know, that's just not true when it comes to politics. Anyway, since January, they bought around $95,000 of Coca-Cola stock, but sold around $325,000. So insiders, smart money, and US politicians are all selling Coca-Cola. That's quite a consensus. Let's dig into the fundamentals to understand why. Return on invested capital, that is a check at 12.7%, and we want to see this number higher than 10%. So the management is doing a decent job generating returns. And what do we know about net profit margin? It is a check averaging 23.4% over 5 years. The industry median is just 8.2%, and Coca-Cola actually has the highest margin in the industry currently. That's the power of the brand. And now let's take a look at share buyback. It's a check. In the last 10 years, they bought back 3.1% of shares. Not massive, but shareholders benefit from owning a slightly bigger piece of the pie. And the debt? It is an X. It would take almost 5 years to pay the long-term debt with the 5-year average free cash flow. And we want to see it under 2 years, so that is definitely a concern here. Revenue growth, that is an X at 0.2% 10-year compound annual growth rate. So basically, Coca-Cola's revenue has been flat for a decade. Free cash flow growth, that is an X at minus 5.5% in the last 10 years. So it's actually declining. But it's not as bad as it looks. If we go to Forecaster and look at the transcripts, we can read that free cash flow, excluding the Fairlife contingent consideration payment, was approximately $560 million, an increase versus prior year. So this decline is mainly caused by a large one-time payment for the 2020 acquisition of Fairlife. Stripping this out, Coca-Cola continues to generate solid cash flows. And earnings per share growth, that is an X at 4.4% in the last 10 years. These growth numbers are concerning. Coca-Cola is essentially a no growth or maybe low growth company at this point. But for dividend investors, this might not be a deal breaker. The dividend yield is 3%, so shareholders can expect to get $2.04 annually per every share. That is a nice yield. And let's take a look at the payout ratio. That is an X at 68%. And we want to see the payout ratio somewhere between 20 and 50%. So Coca-Cola is paying out most of its earnings as dividends, leaving little room for growth investments or debt reduction. And what about dividend growth? It is a check at 4.2% 5-year growth rate. Coca-Cola has been increasing its dividend for 62 consecutive years, making it a dividend king. So we are looking at a mature, slow growth company that returns most of its profits to shareholders. Now let's see if the price reflects that reality. Price to earnings ratio is 27.5. That's quite high for a company with virtually no growth. To calculate the intrinsic value of this company, we will use a discounted cash flow analysis. And since Q1 2025 showed a negative free cash flow due to a $6.1 billion payment related to Fairlife acquisition, we will use a 5-year average free cash flow for a more accurate picture. Okay, so first we have to estimate the growth of Coca-Cola. So in the low scenario, we will estimate a growth of 6% for the first 5 years and then 4%. In the medium, 8% and then 6%. And in the high scenario, 10% and then 8% growth. The low scenario is close to the recent earnings per share growth. The medium scenario is in line with the predicted industry growth of 8.3%, and the high scenario assumes Coca-Cola will grow faster than the industry. So, with such estimates, the intrinsic value in the low scenario is $25, in the medium $30, and in the high scenario $36. Now, we must always apply a margin of safety to those prices. I use a 30% one, but you can use any margin that feels right for you and your risk tolerance. And with such a margin, we get in the low scenario $18, in the medium $21, and in the high one $25. And the current price is around $68. So it is all in the red. Coca-Cola looks incredibly expensive at current levels. But maybe discounted cash flow is not the best way to value Coca-Cola. So let's use a dividend discount model calculator, which you can get access to by becoming a patron. Let's enter the current price of $68.84, annual dividend of $2.04, and the dividend growth rate of 4.2%. So even using the dividend discount model, which is more favorable for dividend stocks, we get an intrinsic value of just $36, which is in line with our high scenario without the margin of safety. So why is everyone selling Coca-Cola? The company has minimal growth prospects. Revenue has been flat for a decade. It carries significant debt that would take 5 years to pay off. The stock is trading at nearly double its intrinsic value. And while the dividend is safe and growing, the high payout ratio leaves little room for the company to invest in future growth or pay down debt. According to Forecaster's AI agent, it is a bit of a mixed situation. On one hand, the stock has outperformed the S&P 500 year to date. The company reported 6% organic sales growth in Q1 2025, alongside improved profit margins, and we get a stable dividend. On the other hand, we can read that some analysts have raised concerns about the stock being potentially overvalued following the significant price increase. Discussions suggest that a price correction could occur, with estimates indicating possible declines of 25 to 50%. It is also worth repeating that Coca-Cola remains a legendary brand with an incredible moat. As we can read on Forecaster, the key moat drivers are brand recognition, extensive distribution network, habitual consumption, economies of scale, and its trademarks and secret formulas. That is quite a lot. So if you would like to check out Forecaster for yourself and analyze thousands of companies listed there, you can use my affiliate link in the description and you will get a free trial and also a 10% discount if at the checkout you will use a code BOLD10. So thank you, Forecaster, for sponsoring this video. Now, it seems clear why insiders, super investors, and politicians are all selling. They are taking profits on an overvalued stock. It's a great company, no doubt about it, but let's not forget about the famous words by Howard Marks. Lesson number 1 is that it's not what you buy, it's what you pay for it that determines whether you'll be successful or not. If you found this video interesting, you should definitely watch my video on top 5 dividend kings to buy and hold forever. Thanks for watching and see you in the next one.